Hello everyone, good afternoon. Welcome to this webinar. Thanks for joining in. So, markets have been quite volatile over the past 12 months, and the reactions have been pretty much sharp when it comes to small caps. So, through the course of this webinar, we'll try to understand how should investors approach small cap as a space, whether they should, is it a time to fear or is it a time to accumulate? We'll try and address this query. So for this, we have with us Mr. Varun Goyal. He is a fund manager at Mirae Asset Mutual Fund. He's a senior fund manager and research equity at Mirae Asset Mutual Fund. Brings in overall 18 years of experience within equity research and fund management. Previously, he has been associated with organizations like Nippon Life India and Motilal Oswal, managing their alternate strategies. So, welcome, Varun.
Thanks, Shrenik. Thanks for having me.
Yeah, sure. So, just to give a broad macro backdrop, how being the macro scenario over the past 12 months, what impacted the markets, what influenced the markets. Varun, if you can just give a brief backdrop on that, what happened and how the markets reacted.
Yeah, so if we look at the calendar year 24 and the first half of calendar year 25, it was difficult time for India from a macroeconomic perspective. There were three large reasons for that. One, there was significant monetary tightening, by RBI, and I know there were a lot of fears, of course, related to inflation and commodity prices at that point of time, and we had seen significant rate measures and non-rate measures by RBI. Second, between the period of April and November 2024, because of the election season, the central government could not spend enough on capex and infrastructure. So there was clearly a slowdown on that because of that. And third thing was the rural consumption had slowed down very materially post COVID. And all these things came together to cause the economic slowdown. If you remember, last year during the September quarter, GDP growth came down to 5.4%. And I think post that we saw a series of changes, which began to play out. Central government, of course, did a lot of heavy lifting in terms of, during the budget in February, it was announced that there will be almost 1 lakh crores of direct tax cuts. And this year, again, what we have seen is this has been followed up with almost 2 lakh crores of indirect tax cuts. So these two things combined, almost 3 lakh crores of tax cuts will go a long way in boosting rural and urban consumption. Second, there is a significant monetary easing by RBI. I know 100 basis points of repo rate cut, 100 basis points of CRR cut, and several measures, non-rate measures, which overall are leading to easing of monetary conditions, the credit becoming cheaper and more widely available. And all of these things we believe will go a long way in boosting short to medium term economic growth. And the third thing, of course, which is playing well, is that there's a second consecutive year of good monsoons. While there's some pockets of excessive rainfall in certain parts of the country, but broadly on a pan India basis, we have seen good rainfall, and because of which we expect a good crop, and because of which we believe the rural consumption will also go up. So if you combine the three things, one is significant monetary easing by RBI, second, significant direct and indirect tax cuts by central government, and the good monsoons together should lead to a much stronger economic activity this year. Already, if you see the first quarter GDP data which came in, it showed real GDP growth at 7.8%. Our census for the year as a whole, the real GDP growth can be around 7%, so which is a very healthy number. Of course, this year inflation is also fairly muted, and our sense is while the RBI has already done 100 basis points of rate cut, they could do at least 1 to 2 more rate cuts going forward if the inflation remains benign. So all this will go a long way in reviving corporate earnings. Last year, we saw corporate earnings of around 3% for Nifty companies, and small and mid cap companies also did something similar. For FY26, our sense is the large cap companies can do 10 to 12% earnings growth, while the small and the mid cap universe can do 4 to 5% better.
Sure. Thanks, Varun. Clearly, based on this macro which you highlighted, the markets reacted sharply and more so when it comes to small caps. while they corrected during the first half, that is between September 24 to Feb 25, they equally rebounded sharply when it during the period March 25 to September 25. So clearly, the sharp rebound is also quite visible, as you highlighted, and it's more to do with the kind of earnings growth projections that we are coming in, the measures that government and RBI have taken, and is l- which may lead to a better overall economic growth and earnings growth going ahead. So, just to go back, just to shift gears, we'll try and understand how the small cap as a space has evolved over the last, say, 5, 10 years. What are the different opportunities available within the small cap space? If you can just let our viewers understand that.
Yeah, so I think the definition of small cap has changed very materially between June 2020 and June 25. So if you look in the 5 year period, what is classified as large, mid, and small has changed very materially. As we know, or just as a recap, the first 1 to 100 companies in terms of market cap are classified by as large cap by AMFI. The 101st rank to 250th rank is classified as mid cap, and 251 and below is classified as small cap. So if you look at in June 2020, the large cap universe started at almost 27,000 crores. And so anything 27,000 crores and upwards was considered as large cap. If you look at June 2025, this number has become almost 91 lakh, 91,000 crores, so almost 3.5 times of what it was in June 2020. Similarly, if you look at the definition of mid cap, you know, 7,000 crores to 27,000 crores broadly. That was where all the mid cap stocks lied. If you look at the data now, so it is almost 31,000 crores to 91,000 crores. So the whole band has shifted almost 3.5 times upwards. And if you look at small caps, basically, if you see what used to be the definition of mid caps 5 years back, has now more or less become the definition of small cap. So today's small cap, if you look at 251st rank to 500th rank, or you can say uh, the first small caps is at 31,000 crores, and the smallest one is at around 10,000 crores. So 10,000 to 31,000 crores broadly is the universe. So what we have seen in the last 5, 6 years, because of the economic growth, because of better profitability, better revenues, the definition of small cap itself has changed very materially, and therefore, the way we look at small caps need to be recalibrated and changed. Today's small caps are much larger in size as compared to what they were. They are no longer the feeble or weak balance sheets. These companies, a lot of them are leaders in their own field of operations, just that the niche that they operate in is pretty small. So I think the small cap universe has evolved very materially, and therefore it now gives a lot of scope for bottom up stock picking. It is very widespread in terms of sectoral representation. In fact, several fast growing sectors find much better representation in small and mid as compared to what they find in large cap, because a lot of new sectors and themes and stories have come in. So just to give some example, if you look at sectors like renewable energy, green energy, solar power, most of the companies are part of the small cap and some in the mid cap space. If you look at battery storage components, most of the companies will be there in the small and the mid cap space. If you look at several new chemical companies, if you look at the whole EMS ecosystem, which is where India is trying to have a presence in electronics manufacturing, most of the companies are part of the small and the mid cap space. Similarly, capex oriented sectors, if you look at, to the exception of a few names, most of the defense companies you would find, or railways companies you would find part of the small and the mid cap universe. Real estate, to the exception of a few names, the most of the building material and the real estate sector has presence in the small and the mid cap space. So I think a lot of the faster growing parts of the Indian economy have much larger representation in the small and the mid cap space, and therefore, yeah, if one's intention is to participate in the faster growing Indian economy, one would need to have some representation of small and mid cap. Of course, it goes without saying that it comes up with much more risk and volatility.
Sure, Varun. Just to sum up for the benefit of our viewers, small caps today have grown in potential in terms of the overall coverage, and they truly represent in a broader representation from a overall economic sense. They give a much broader representation of the overall economy, and hence one needs to participate in this space if he is looking from a longer term perspective. So Varun, while you highlighted about the overall how the small cap space has evolved, if you can just also let us know in terms of what is the growth potential for small caps, where the earnings are and where the valuations are headed, whether this is a good time to look at small caps.
Yeah, see, I think if you look at the small cap index, there are certain components in, let's say, if you take Nifty Small Cap 250, which are expensive, which are, there are definitely pockets of fraud. If you look at some defense, railways, PSU stocks, some engineering stocks, they're trading at very high valuation. There are certain capital market plays, AMCs, insurance companies, some capital market participants, which are again trading at expensive valuation, some EMS companies. So I think around 30-35% of the benchmark, which is into some of these high growth pockets, is trading at much higher valuations. But if you look at the remaining two-thirds of the index, which is sectors like banking, sectors like chemical, sectors like NBFCs, the overall sectors which are more geared towards the India-facing economy are trading at much more reasonable valuations. So, for instance, several engineering companies, you can say several auto companies, auto ancillaries, several consumption names, both discretionary and staples. We find the valuations are more in line with their long period averages. And therefore, there is a lot of scope for bottom up stock picking. So, I think one can really pick and choose in terms of what names one wants to invest in the small cap universe.
Sure, sure. And what we can also want to highlight to our viewers is in terms of it is the small cap space where you will find the most multi-baggers when it comes to small cap as a space. While there are risks involved, but if we get it right, obviously the kind of growth that we can see in small cap space can be very significant. And even if you look from a long-term perspective, if someone would have invested pre-COVID and post-COVID for and held it for more than 2 years, the returns would have been significantly higher when it comes to small cap versus a large cap. And if you held it for a longer period, say 5, 10, 15, 20 years, the compounding makes a lot of difference. So, coming to the fund you manage, Varun, if you can just let us go through in terms of how you manage, how do you approach small cap as a space? What is the overall fund philosophy, the strategy of the fund, portfolio construction? What is your current positioning, where you are overweight, where you are underweight? If you can just highlight.
Yeah, so we launched our fund in January of this year, and the during the NFO we raised around 1,000 odd crores. The current AUM is closer to 2,400 odd crores. So the fund is fairly small in size, which gives a lot of flexibility in terms of bottom up stock picking. The founding, of course, principles of the fund being that we want to invest in companies with sustainably high earnings growth, with good capital efficiency, low or negligible leverage, and good corporate governance. And of course, one wants to invest, combine all these factors with a reasonable valuation. So growth being one of the most important pillars, as long as it is available at a reasonable valuation. From a market cap perspective, of course, the small cap fund, the fund predominantly has to be in the small cap space. So minimum 65% can go upward up to 100%. And theoretically, it can have up to 35% in the mid and the large cap space. So what we did when we launched the fund, because there was a lot of volatility, if you remember the period of Jan, Feb, March, there was a lot of correction and volatility in the small cap space. We used the exposure in large and mid up to 35% to tide over that volatility, and started gradually creating our investments in the small cap space. So we have a lot of interesting ideas and themes that we have brought in the portfolio. Like I said, the portfolio is more inward oriented. We believe this is a year for strong cyclical revival and recovery in India's economic growth. So we like sectors like banking and finance, certain capital marketplace like insurance, AMCs, capital market participants, wherever we see valuations are palatable. Auto and auto ancillary, we believe, thanks to the big GST cuts and interest rate cuts, should do quite well. Real estate, again, we believe it's the middle of the cycle, and we expect the sector to do quite well going forward. Several engineering, industrial product companies are, we believe, in the midst of a 3, 5, 7 year kind of upturn, and there is a long way to go. So some of these capex stories will definitely benefit, and there are several emerging names and stories in terms of, as the Indian economy gets a slice of manufacturing along with this very robust service sector that we have. I think some of these industrial segments will also do quite well. So broadly, what we are saying is that the domestic cyclical story will do quite well. Along with it, certain export themes like the pharma CDMO opportunity, which we believe is a sunrise industry and should do quite well. Healthcare space in terms of diagnostics, hospital chains is a theme which plays shift from unorganized to organized, which is again something that we believe should do well going forward.
Sure, Varun. So, Varun, while this has been a very short time frame, fund was launched in January 25. The fund has done phenomenally well in terms of outperforming the benchmark and the overall category. So, if you can just highlight for the benefit of you, our viewers, what has been the key reasons why the perform has done fairly well?
Yeah. So if you look at the fund, I think as of 19 September, the fund has around 18% absolute positive returns, and let's say around, I think, 7% odd outperformance on a since inception basis. I think the primary reason, the way we look at it, is that our portfolio companies have been delivering good earnings growth, and our senses for the next 2 to 3 years, our expectation would be that these companies should deliver good economic growth. Our belief is that if we buy good quality companies, good small cap companies, which have tailwinds for growth, if they can deliver good top line growth with their margins intact, and as interest rates come down, there will always be some financial leverage to play on. We believe these companies can grow earnings at 15 to 20% over the next 2 to 3 years. And I think despite a soft economic environment in the last 6 to 12 months, some of the companies that we own have been delivering fairly healthy profit growth, and we hope that trend can continue going forward also. So that is really, the fund is, our endeavor is to have companies which can consistently deliver good earnings growth over the next 3 to 5 years.
So while the focus remains on generating better returns, but at the same time, we are also equally focused in terms of risk mitigation, as you highlighted.
Yeah, absolutely.
Yeah. So broadly, this is what we discussed so far in terms of why small cap as a space looks very interesting at this juncture. With the various reforms, GST being one of the major reforms over the past 10, 15 years, fiscal monetary again remain very aligned and supportive for reviving overall economic growth, reviving consumption demand. Earnings are likely to turn around from here for over the next 2 quarters, with a lot of support measures coming in. Consumption and overall credit growth, overall economic growth should do well from here on. And from a longer term perspective, small caps make a lot of sense. Possibly the current volatility offers an opportunity to accumulate from a long-term standpoint, and those investors who have the adequate risk appetite to invest in small caps should look at this space for achieving their long-term goals. So Varun, before I open the floor for questions, a couple of questions from my side in terms of how can you just highlight for the benefit of our viewers, what can compounding make a difference in terms if someone is invested for say 15, 20 years, what a 5% kind of CAGR could make a difference on the overall portfolio?
Yeah, see, it goes without saying that small caps come with the potential for higher returns, but they also come with the potential for larger drawdowns or more volatility. So just to, if you look at the index, Nifty Small Cap 250, if you look at that index has existed for almost 20 years, and there is a IRR of around 17%. If you look at, the large cap indices, the number would be closer to 11, 12%. So there is a 4 to 5% gap between the IRR returns of the small cap space versus the large cap space. Of course, small caps by virtue of their way smaller in size are more volatile. So in my 18 years career, I've seen at least 5 to 6 instances of almost 25, 30% correction in the small cap space. If you look at just 1 year back, from September of 24 till April of 2025, all in a 6 month period, we saw small caps index correct around 25%. And of course, several companies corrected 30, 40, 50% or even higher. So we could see bouts of volatility. So our recommendation always is that investors who are coming to small cap should have at least a 5 year view in mind. Only that money that they can invest or stay invested for at least 5 years, that allocation should come to small cap. Of course, small caps have the potential for larger returns, but you can always see 20, 30% kind of drawdowns every 3, 4, 5 years, which is something which has happened in the last 20 years also. Having said that, while these are the pitfalls, if you look at the long term compounding, if you are looking at objectives like you're saving for your children's education, for your own retirement, or upgrading your house, or for various long term investment goals, small caps do come in handy. And therefore, our view is that every investor should have some allocation to small cap. How much is, of course, a function of your risk return profile and ability to see volatility and drawdowns.
Sure. Varun, a follow-up question to that would be at this point in time, how should one allocate within the small cap, whether it should be lump sum or SIP, staggered manner, or a combination?
Yeah, so when we came up with the NFO during January, our recommendation was that if you want to put 100 rupees in the small cap fund, please put 50 right now, and the remaining you can spread over next 6 to 12 months through SIPs. And the recommendation still remains the same, that those investors who are looking to invest in our small cap fund, they can put 50 rupees upfront, and the remaining 50 they can spread out over the period of next 6 to 12 months.
Sure, sure. So, participants, in case if you have any questions, you can put in the Q&A box and we'll try and answer. So first question is from Mr. Paresh Budhia. He's asking, if we talk from a perspective of asset allocation, what percentage of small cap should be good enough for the overall portfolio? Uh, what are the criterias for selection of good growth and good governance in small cap companies, if I can elaborate? I think first part of the question you have already answered, that the percentage allocation would depend on the risk appetite, the risk profile, and the time horizon of the investor. So second question, which is, what are the criterias that you look at while selecting good growth companies, growth-oriented companies, good governance-oriented
Yeah.
small cap companies?
So I think as far as corporate governance, it's very subjective matter, but there is of course a lot of things that one can look at. One can easily go back in history and see what is the kind of corporate governance and accounting standards that company is following. One has to look at the cash flow profile. What is the situation in terms of working capital? What is there any accounting red flags? Has the company been paying regular dividends, which shows whether it has concern for minority shareholders, whether there is too much leverage on the balance sheet? Is there a lot of inter promoter or intercompany transfers, transactions? Are there other promoter group entities which are doing business with the company? So there are a lot of things, which one can check. At the end of the day, of course, things can still go wrong, like we saw in the case of Satyam. Right, despite it being part of Nifty and Sensex, there was still concern. So this requires very careful deliberations and continuous engagement with the company managements to get a broad sense on what are the company's ambitions, objectives are, and how do they plan for the company's future.
Sure. Varun, another question from one of the participants is, what happened over the weekend in terms of H-1B1 visa in the US front. So, IT sector has got impacted because of that. So, one is, why it is not part of the top 10 sectors in your small cap fund portfolio? And second is, what could be the implications for the markets and for the IT sector?
Yeah, so as you mentioned, there are a lot of changes happening from a US government perspective, both in terms of mercantile trade and services. I think clearly H1B policy changes that were done by the US government over the weekend are a negative for Indian IT industry, because it means that getting a H1B visa becomes incrementally more expensive and more difficult. And therefore, a lot of companies which are dependent on that will have a higher cost and time delay. Of course, this year we do not expect any material impact on the revenues and the profitability for FY26 because the people who had to go, the lottery was already done, the visas are already granted. So we don't see revenues and bottom lines being impacted in FY26 and maybe in the first half of FY27. But after that, it will become, it can start impacting. Also, please keep in mind that for most tier one, tier two Indian IT companies, almost 50% of the revenue comes from North America, and so therefore any regulatory changes there will have some bearing. So we believe different Indian IT companies will find ways to mitigate that, whether in terms of more offshoring or hiring Native Americans. So I'm sure they will find a way, but in the short term, this can definitely have a bearing from a cost and a time perspective. As far as our portfolio is concerned, we have a slight underweight position on the IT space with focus more on companies which do most of the work back here in India, which do more BPO kind of a work and require limited on-site presence.
Sure. Mr. Rajarshi Chaudhary is asking whether he should invest in a small cap index or he should go invest into an actively managed small cap fund.
Yeah, so I think the choice is with the investor. Both kinds of products are available. As far as Mire Asset MF is concerned, we have index fund also, we have active fund also. So both products have their own advantages and disadvantages. I think that's something the investor has to, decide.
Sure. Mr. Sanjay Trasi is asking why small caps are prone to higher volatility and this fear of steep drawdowns, why this is there in small cap.
No, so I think if you look at, let's take the same example, FY. So between September and September 24 and April 25, Nifty corrected 15%, mid cap corrected 19%, small cap corrected 25%. So everything corrected. It's very rare, or I mean, very, very rarely you will see that small caps are correcting, but the rest of the market is not. But just the trend that some of the smaller companies tend to be a little more volatile. I'll give you some example. Let's say, it's a Nifty company or a large cap company. Typically, it would have a high credit rating. It would be borrowing at 6, 7, 8%. There is a small cap company because the balance sheet is smaller, the credit rating may be lower, they may be borrowing at 9, 10, 11%. So their interest rates are different, their ability or their negotiating power with their suppliers, customers is at a different level. And therefore, you will see that whenever there is a big commodity price shock, large cap companies, while they suffer less. Small cap companies, because their negotiating power is lower, they suffer more. But the flip side or the contrary thing is also true. So when the commodity prices come down, the small cap companies benefit a lot more than the large cap companies. Similarly, when interest rates come down, the small cap companies better a little bit more than the large cap pairs. So it is also about the size of the company. It is about their negotiating power with their customers and with their vendors and suppliers. And typically, because there is a perception of higher volatility, and therefore every sign of trouble, the retail investors and some of the HNI investors tend to, you get transact or be, get in, get out a little bit more because of the perception of it. With all these things combined, create a little bit more drawdown on the way down, but on the upside also, as you have seen in the last 20 years, the returns are better. So both sides, it works both ways. You have higher rewards, but it comes with more volatility.
Yeah. So as you clearly rightly mentioned, while they are risky, but at the same time, the potential is higher enough. And if you elongate the time period and also invest in a staggered manner, obviously the volatility reduces considerably, and then you enjoy the benefit of compounding. So Varun, my next question is, while you have spoken about valuations, even though valuations don't look cheap at the current juncture, but there are still some pockets of opportunities wherein the valuations are reasonable. So if you can just again elaborate on that piece, because people are asking in terms of whether how the valuations are vis-a-vis large caps, whether one should invest from a valuation standpoint, does it make sense to invest today? Or they should wait out and then invest.
Yeah. So I think, like I said, there are definitely some pockets of froth in some of the more popular sectors. So let's say defense, railways, PSUs, engineering companies, some EMS companies. So what we have tried to do is to have low or negligible exposure to some of these most chased or most popular sectors. At the same time, since our fund size is smaller, only 2,400 crores, our requirement from a liquidity perspective is also lower. So we do not necessarily have to chase the most expensive name in the small cap category. So that's somewhere I think that's also a benefit. So what we are trying to do is in those sectors that we believe growth is very compelling, instead of buying a very expensive small cap name, you could have let's say some of the larger companies, because as I said, SEBI allows you to have at least or up to 35% in large and mid. So that is something also we have used in those sectors where we want representation, but we find the small caps to be extremely expensive. And like I said, two-thirds of the index, which is your domestic facing sectors, a lot of them like banks and financial services, auto, chemicals, real estate, select capital goods. These are trading at a fairly reasonable valuations, and that is where we have done a lot of stock picking. And we believe that you make a balanced portfolio, both from a growth and a valuation perspective, when hopefully earnings growth can deliver in the next 2 to 3 years.
Sure. Varun, Mr. Chandra Joshi is asking, what is your outlook on the overall auto sector and the textile sector post the tariff announcement and post the GST rate cut? While auto, what's your view on both of these
Auto
sectors?
clearly is a big beneficiary of both the interest rate cuts and the GST cuts, and we expect the sector to do well for the next 12 to 18 months. I think the sector last 4 or 5 years has been difficult post the BS6 implementation, and we believe we will see very robust volume growth, and therefore the auto OEMs and the ancillaries both will benefit. As far as the textile sector is concerned, clearly the companies which are focused on exporting to US are impacted because of the steep tariff that has been imposed. And we wait more clarity from Government of India in terms of there is expectation that there will be some kind of a package which can help some of these exporting companies, especially those geared towards the textile and leather space. But we wait for more details coming out from the central government side. Meanwhile, of course, there is expectation that some of these companies will be able to divert their products from US to other geographies like Europe and Japan. And so that continues to be a work in progress. One has to wait and watch out for more clarity on these things.
Sure, sure. Tanisha Bansal is asking, what kind of valuations do you prefer, or what are the criterias that you look at while redeeming a particular stock or avoid buying a particular stock?
So, like I said, so we look at growth and sustainability of growth, high return on equity, return on capital employed, balance sheet, whether it has too much leverage, we'd like to stay away. And then fourth is, of course, valuation. So all these things combined, we take a call holistically whether the company will continue to be a high growth company for the next 2, 3, 4 years, and it should be available at a reasonable valuation.
Sure. So, Mr. Jitendra Gangwar is asking, although Indian markets have been in sideways and we have seen time correction and not so much of price correction, uh, we are still trading expensive when it comes to the global markets. So, what's your view on that, and how's the geopolitical situation? Will that impact have a role on the overall equity market performance for India? And FPIs have been consistently being selling Indian equity. So what's your view there?
Very difficult to predict how the FPIs will behave. Of course, in the last 2.5 years, they've been net sellers. And there's a lot of domestic money which has come routed through mutual funds, insurance companies, pension authorities, which has been the primary driver of the Indian equity markets in the last some time. I think the very robust domestic savings which is coming in Indian equity markets. I think if you look at the valuations, of course, from a global perspective, emerging market perspective, Indian markets are more expensive, but they've traditionally been more expensive than some of the other emerging market counterparts. I think the premium or the gap between the two has come down very materially in the last 1 year. So I think relatively from how we were placed last year, we are much better placed this year. So I think last year two things happened. One, the valuation premium was very high. Second, our earnings growth slowed down very materially to almost 2-3%. So this year we expect both earnings growth to come back. And second, of course, like you said, 1 year we saw almost zero returns in the market. So both things together, have made the valuations more palatable.
Sure. You already answered. Would you recommend lump sum or STPs in your small cap fund? It has to be a combination. 50% can be allocated through lump sum, and 50% can be done in a staggered manner through SIPs and STPs. We may not be able to comment on individuals' companies. Varun, Mr. Sanket Patel is asking, can you give your view on the lending space? What's your view on the overall financial services as a space and within that lending as a space?
As far as lending space is concerned, both banks and NBFCs, they continue to be one of the most attractively priced sector in the market. I think we have seen a very significant rate cut, and whenever rate cuts start, initial few quarters, we see margin pressure on banks because their assets get repriced faster and their deposits take time to get repriced. So I think last quarter and this quarter again, we will see some pressure on NIMs, but post which we expect margins to recover. Also, with so much, 100 basis points of rate cut, we expect credit growth for the system as a whole, which is running at around 10%, to go back to around 12%. And that incremental growth will definitely help some of the larger banks to grow at 13, 14, 15%. And for that reason, we remain constructive. We believe NBFCs are faster in terms of passing the interest rate cuts on both assets and liability sides, and therefore we are more positive on NBFCs as of now. And but we believe from a 12 to 18-month perspective, even the large banks, mid-tier banks should do well. As far as the capital market companies are concerned, we believe that is a 10-year theme. As more financialization of savings happen, we expect that sector to continue to do well going forward.
Sure. So Varun, while you mentioned that it will take at least a couple of quarters for earnings to see a revival from here, uh, the question from Suchit Saxena is, when do you see forcing earnings of companies coming back? And also your take on Indian markets in case US goes in recession next year.
So, like I said, for FY26, we expect 10 to 12% growth for Nifty companies, and we expect small and mid cap companies to do better, at least 4 or 5% better than the Nifty companies. As far as US going into a recession, of course, that's something we continue to watch out for. As of now, we don't think US is getting into a recession anytime soon. The US Federal Reserve has also started cutting interest rates because some of the job data which was coming out was on the softer side, and we expect as more rate cuts happen, that should boost economic growth in US. So while that's something that we continue to monitor, our sense is, as of now, at least for the next few quarters, we do not envisage a recession in US.
Sure. Varun, one question is, how much of your current portfolio is allocated beyond 500 companies?
Well, I don't have the exact number right away, but I know our portfolio has a good representation of companies from the top 500 and even below that. So our universe per se is from 251st rank to 1000 rank, and I think almost 90% of the fund will be in that space.
Sure. Mr. Shayan Ahmed is asking, are you seeing any risk emanating from US economy which can impact equity returns?
Yeah, like I said, I know we continue to watch out and track US economy. And of course, any big recession in US is always worrisome, not just for India but across the world. But as of now, we do not envisage a big. While there is some slowing down of economic activity, we do not think US is getting into a recession as yet.
Sure. Mr. Jeevan Akole is asking, any semiconductor play that you are playing through this fund?
Yeah. So as you know, there is the government of India has a concerted effort on developing the whole semiconductor space in India. Various programs are going on. Subsidies have been given to various companies to set up semiconductor plants in India. And that is something which will take time. This will not come overnight. I think in the next 5 to 10 years, we should have a very vibrant ecosystem as far as the overall manufacturing, testing, design, all of these capabilities are concerned. And this is a very interesting and promising space. There are several companies which have started doing this, but it's still very early days, and it is not very material in the P&L or balance sheet of any company as yet. But over a period of time, I'm sure a lot more companies will get listed. There's a lot more representation which will come in.
Sure. Thanks, Varun. So we don't have any incremental questions, so would request for your closing remarks.
Yeah, so I know, Shrenik, like I said, small cap is always a very vibrant and interesting opportunity. And like they say, for Spider-Man, with great power comes great responsibility. So we believe that small cap also, with potential for great returns, comes potential for great volatility. But for those investors who can see a 20-30% drawdown and have a 5-year investment view, we believe small caps make a lot of sense.
Thanks, Varun. Thank you so much. Thanks, participants, for joining in for today's webinar, and we look forward to your participation. In case if you have any suggestions for us to improve on the webinar in terms of what we want to cover, we are happy to take those suggestions. In case if you have any queries, you may get in touch with your respective financial advisors or through us sales representatives, and we'll be happy to address those queries. Thanks a lot for joining in. Thanks for